Welcome SIE candidates, Economic Factors. This video series will analyze various widely accepted measures of economic conditions and how the economy influences the decision-making process of both issuers and investors. Consideration will be given to how economic factors affect market participants, including interest rates, inflation outlook, currency valuations, and the perceived direction of the economy. The video will also provide a brief review of some basic financial statements used by investors to assess the financial health of a corporate issuer. The provisions of the Securities Act of 1934 govern the format and contents of these statements. Economics. The performance of an investment is influenced by the performance of the economy. A looming recession may reduce demand for equity securities, while inflation or deflation can disrupt expected returns across many asset classes. Fear of rising interest rates and falling bond prices may lead fixed-income investors to shorten their maturities. Currency instability might prompt investors to rebalance their portfolio's global exposure. Essentially, when developing an overall investment strategy, many economic factors must be taken into account. Measuring national output. Economists generally aim to gauge the relative economic health of a country. Two key measures of U.S. economic activity are the gross national product and gross domestic product. Gross national product, GNP. GNP sums up the total value of all goods and services produced by a nation's economy. For the U.S., GNP includes goods and services produced overseas by U.S. companies. Gross domestic product, GDP. GDP has replaced GNP as the primary measure of output and spending within the U.S. Its significance lies in including the output of all goods and services produced by labor and property located in the U.S., regardless of the producer's origin. For example, in the U.S., GDP includes a Toyota plant in Columbus, Ohio. Components of GDP include consumer spending, investments, government spending, and net exports. The most useful variation is real GDP, which is adjusted for inflation using constant dollars and is regarded as the primary indicator of overall economic activity. Rising GDP indicates economic growth and potential inflation. Inflation. Inflation is characterized by a persistent and significant rise in the overall price level. It occurs when demand for goods and services outpaces supply, meaning there's too much money chasing too few goods. Consumer Price Index, CPI. The CPI is widely viewed as the most important inflation measure. It tracks the prices of a fixed basket of goods purchased by typical consumers. If these prices rise, the economy is experiencing inflation. Periods of inflation are often marked by rising interest rates. Besides bonds, interest rate-sensitive stocks such as utilities and financial services companies also react considerably to interest rate changes. Since utility companies are highly leveraged, rising interest rates make it more expensive for them to raise capital. Higher interest charges reduce earnings, leading to lower security prices. Equities as an inflation hedge. Historically, equity securities and related products such as equity mutual funds, equity ETFs, and variable annuities have offered effective protection against inflation. Securities with payments fixed at issuance, unaffected by inflation, are most vulnerable to inflation risk, also called purchasing power risk. Commodities as an inflation hedge. Commodities like gold and silver tend to perform well during inflationary periods. Investors can gain exposure through direct investments in these commodities or through futures or derivative products like mutual funds and ETFs. Fixed income investors worry about inflation. Compared to equities, fixed income securities are more exposed to inflation risk. Inflation poses a dual threat. 1. Rising interest rates will lower market prices of bonds, and 2. The purchasing power of interest payments will decline. If higher rates are expected, bondholders often shorten their maturities, that is, reduce portfolio duration, to limit price declines. Some may also hedge against inflation by buying inflation-indexed bonds, such as Treasury inflation-protected securities. Tips. Real interest rate. The real interest rate is the rate of interest that a bond investor expects to receive after accounting for the decline in purchasing power caused by inflation. The formula for calculating the real rate is the bond's yield minus the inflation rate. For example, if an investor buys a 5% bond while the inflation rate is 2%, he expects to earn a real interest rate of 3%. This explains why bond investors demand higher returns during inflationary periods. Essentially, they are considering the decrease in their future payments' purchasing power. Please note, yield minus inflation rate equals real interest rate. Deflation. Deflation is characterized by a persistent and significant decline in the general level of prices. It can be caused by the supply of goods and services exceeding demand, leading producers to lower prices to attract fewer buyers. Deflation should not be confused with disinflation. As a reminder, deflation involves falling prices, while disinflation refers to a slowdown in the rate of inflation. Measurements of economic activity. The following summarizes some of the most common measures of economic activity that students may encounter on the SIE exam. Gross domestic product, GDP, measures the output of goods and services produced within the U.S. regardless of the producer's origin. It is a key measure of overall economic activity. Consumer Price Index (CPI) tracks changes in the prices of goods purchased by typical consumers and is a primary indicator of inflation. Inflation occurs when too much money chases too few goods, leading to rising prices of goods and services. High inflation often accompanies high interest rates. Deflation is a broad decline in prices, frequently caused by a decrease in money or credit supply, which tends to drive interest rates downward. Note: throughout the regulatory exam, acronyms like GDP and CPI may be used instead of their full names. The business cycle. Over time, a pattern of economic fluctuations emerges, represented by the business cycle, which describes the recurring sequence of changes in economic activity. The business cycle has 4 phases: expansion, recovery, peak, contraction, recession, and trough. Expansion. During expansion, economic activity increases, production and demand grow, and employment rises. At this stage, businesses and consumers often borrow money to expand, causing interest rates to increase. Peak. As the cycle reaches its peak, demand for goods exceeds supply. With consumers having ample funds to buy a limited supply of goods, prices begin to rise, leading to inflation. As prices increase, consumers' purchasing power diminishes. Contraction. As prices continue to rise, demand wanes and economic activity slows down. This marks the beginning of the contraction-recession phase. During contraction, businesses lay off workers, unemployment rises, and the rate of inflation, the rate at which prices are rising, slows down. Disinflation. When prices fall, this situation is known as deflation. Trough. The cycle reaches its lowest point at the trough, where the economy's decline bottoms out. Lower prices eventually stimulate demand, prompting the economy to enter a new period of expansion, called a recovery. Sometimes the decline can be severe. A recession is defined as a decline in real GDP for 2 consecutive quarters, 6 months. A depression occurs when real GDP declines over a longer period. Business cycle indicators. While the economy generally follows a pattern, it can be difficult to predict the exact direction at any given time. Economists rely on 3 types of indicators that provide monthly data on economic movements as the business cycle progresses through its phases. These are leading, coincident, and lagging indicators. Although there are various definitions, this summary uses the most widely accepted version from the Conference Board, a global, independent research group. The government index of 10 leading economic indicators is released monthly. The components of the index include average weekly hours in manufacturing, average weekly initial unemployment claims, new orders for manufacturing, covering consumer goods and materials, the ISM index of new orders, which reflects the level of new customer orders, new orders for manufacturers, specifically non-defense capital goods, excluding aircraft, building permits issued for private housing units, prices for stocks in the S&P 500 index, the leading credit index, which comprises 6 financial indicators based on various yields, the interest rate spread between 10-year Treasury bonds and the federal funds rate, average consumer expectations for business conditions. Coincident, economic indicators typically mirror the movements of the business cycle. The 4 components of coincident indicators are employment levels on non-agricultural payrolls, personal income minus transfer payments, which include aid such as Medicare, Social Security, and veterans benefits, the index of industrial production, manufacturing and trade sales. Lagging economic indicators refer to items that change after the economy has progressed through a specific stage of the business cycle. These indicators should confirm the economic condition indicated by the previous leading and coincident indexes. Their components include average duration of unemployment, the ratio of manufacturing and trade inventories to sales, changes in labor costs per unit of output for manufactured goods, the average prime rate charged by banks, outstanding commercial and industrial loans, the ratio of consumer installment credit to personal income, changes in the consumer price index for services, the effect of the business cycle on securities markets. As the economy advances through different phases of the business cycle, bond and equity markets react accordingly. Investors observe these changes and adjust their strategies to capitalize on economic shifts. Interest rate changes. The level and direction of interest rates influence numerous investments and can signal inflationary trends. Consequently, interest rates and inflation effects are vital considerations for investors when selecting investments. Since bond investors worry about inflation reducing the purchasing power of their interest and principal payments, they aim for a rate of return exceeding inflation. Hence, investors often calculate the real interest rate on their investments. Various interest rates are published daily in the Wall Street Journal. Some of the most significant include prime rate, the rate commercial banks charge their best corporate clients; discount rate, the rate at which depository institutions borrow from the Federal Reserve; federal funds rate, the interest charged on overnight reserve loans between member banks; call rate, the rate commercial banks charge on collateralized loans to broker-dealers, mostly for margin purposes. Generally, the order of these rates from lowest to highest is the federal funds rate, the discount rate, the call rate, and the prime rate. Classifications of common stocks. Market professionals categorize common stocks into various groups based on how they perform in different economic conditions, their market capitalization, and their potential for short-term or long-term capital gains. Although basic descriptions of many of these classifications were provided in earlier videos, this section will offer more detailed information. Cyclical stocks. The performance of cyclical stocks typically parallels economic changes. During prosperity, these companies thrive. However, they decline when the economy deteriorates. An example of a cyclical stock is the stock of a machine tool company. As the economy grows, new orders for machinery increase, boosting the stocks of machine tool companies. Other examples include basic industries such as rubber, steel, and cement, construction firms, transportation, automotive, and energy companies, as well as home builders and manufacturers of durable goods. Defensive stocks. Defensive companies' stocks tend to react less to changes in the business cycle compared to cyclical stocks. Examples include utility, tobacco, alcohol, cosmetic, pharmaceutical, and food companies. Because people always need basic services, these companies are the last to be negatively impacted during tough economic times. Generally, demand for their products and services remains stable even during downturns. Growth stocks. Growth stocks belong to companies whose sales and earnings are growing faster than the overall economy. These companies usually reinvest most of their earnings to expand, paying little or no dividends to shareholders. Although these stocks are generally riskier than others, they offer higher potential for capital appreciation. Investors seeking capital growth rather than immediate income find these stocks suitable for long-term investment. From an analytical perspective, growth stocks often have high price-to-earnings (PE) ratios and low dividend payout ratios. The PE ratio is calculated by dividing the current market price of the stock by its earnings per share. For example, if DEF stock trades at $180 per share and earns $10 per share, its PE ratio is 18. To determine the dividend payout ratio, divide dividends per share paid to shareholders by earnings per share. If DEF paid a $2 dividend, its dividend payout ratio is 20%, $2, $10. Value stocks. Value stocks tend to trade at lower prices relative to the issuing company's fundamentals, such as dividend yield, earnings per share, sales, price-to-earnings ratio, and market price-to-book value. They are considered undervalued by value investors. These companies often have high dividend yields, low price-to-book ratios, or low price-to-earnings ratios. However, buying a value stock comes with the risk that there may be a valid reason for its undervaluation and ongoing neglect by investors, which can prevent the stock's price from rising. Value investors are often seen as contrarian because they buy stocks that are unpopular with most investors. Market capitalization. An additional way to categorize a stock is by its total company value, known as market capitalization. It's calculated by multiplying the total number of outstanding common shares by the current share price. For example, if ABD Company has 10 million shares outstanding and the shares are trading at $25 each, the company's market cap is $250 million, 10 million x $25. Outstanding shares include shares held by institutions, retail investors, and restricted shares held by insiders. They do not include treasury shares, which are shares the company has repurchased. Remember, outstanding shares are calculated by subtracting treasury shares from the total issued shares. The following lists the main categories and their common capitalization ranges. Large cap stocks have a market value over $10 billion. Mid-cap stocks are valued between $2 billion and $10 billion. Small-cap stocks range from $300 million to $2 billion. Micro-cap stocks are between $50 million and $300 million. Nano-cap stocks are valued below $50 million. The boundaries between these categories are neither officially defined nor always clear. Over time, a stock's category can change as its market value fluctuates. Small-cap stocks usually represent newer, less established companies, while more established firms tend to be mid or large cap stocks. Small caps are generally more volatile than large or mid-cap stocks, but may also grow faster and offer more potential for capital appreciation. The micro-cap category includes companies with very small market values, $50 million to $300 million. These companies typically have low share prices and are extremely volatile and risky. The newest unofficial category is nano-cap, which includes companies with a market value below $50 million. Nanocaps also tend to have low share prices and are very volatile and risky. Influencing the economy, monetary and fiscal policy. Many theories explain why the economy moves in cycles and what can be done to control those cycles. Here we review two of the most popular economic theories, Keynesian and monetary. Keynesian theory. Keynesian economic theory suggests that government intervention is necessary for sustained economic growth and stability. Originating from British economist John Maynard Keynes, it states that fiscal policies like tax and spending programs should be used to combat inflation and deflation and to influence economic activity. Fiscal policy. Fiscal policy involves the government's use of taxes and spending to maintain a stable, growing economy. For example, during a recession or downturn, the government might increase spending to boost demand or cut taxes to increase disposable income for consumers. These actions aim to stimulate demand indirectly. Conversely, if the economy overheats with excessive demand, the government may reduce spending or raise taxes. Fiscal policy decisions are made by the President and Congress, which sometimes leads to political motives influencing economic choices. Nonetheless, the main goal is to promote economic growth and high employment. In contrast, monetary policy is managed by the Federal Reserve, which is theoretically independent of political influence. Monetary theory. Monetary policy seeks to control the money supply and credit to influence interest rates and economic activity. The Federal Reserve implements this policy in the U.S., primarily focusing on controlling inflation, easing or tightening money. The Fed's approach involves easing or tightening the money supply. An easy money policy increases the amount of money and lowers interest rates to stimulate the economy. Conversely, a tight money policy reduces the money supply and raises interest rates to slow economic activity and curb inflation. Yield curves. During periods of easy money, interest rates on short-term debt are lower than those on long-term debt, resulting in an upward-sloping yield curve. During tight money periods, the yield curve can invert, meaning short-term rates are higher than long-term rates. Money supply. Money is the measure of value used to buy goods and services and serves as a medium of exchange. The Federal Reserve aims to control the money supply and credit to maintain a stable and growing economy while battling inflation. Before diving into specifics, let's define key measures of the money supply. M1 includes currency in circulation, demand deposits, and other checkable deposits. M2 includes everything in M1 plus money market deposit accounts, MMDAs, savings accounts, small-time deposits, balances at money funds, and overnight repurchase agreements at banks. Changes in economic conditions influence the Federal Reserve's focus on these money supply figures. The Fed releases weekly data on M1 and monthly data on M2. To keep things simple and easy to understand, we'll be brief and to the point. Join us for a follow-up video where we continue the discussion. As always, please like this video so others can benefit. If you're new here, we invite you to join our community with a free subscription.